Hi everybody, it's AJ speaking. I wanted to give you an update on interest rate cut expectations as implied by Fed funds future pricing. Each of these 5 lines represent one of the next 5 Fed meetings where they announce interest rate cuts or no cuts. The red line shows you the current level. The current level is at 425 to 450 basis points, or 4.25% to 4.5%. From today's perspective, July 22nd, the next meeting is only 8 days away. This is on July 30th. And this is this blue line here, and you can see the gap between this blue line and the red line is almost nothing. This means the market does not expect any rate cut. Each line is probability weighted, and the smaller the gap between a line and the red line, the less deviation from the current level the market expects. But if we go to the next meeting, September 17th, there's the green line. You can see there is a gap, and when you look at this little dotted line, this would represent one cut. So if the green line would be very close to the dotted line or would touch it, it would mean that the market would expect on a probability weighted basis that a cut was very likely and was priced in. But right now, the green line's endpoint is roughly in the middle between the red line and this first cut line. So currently the market is kind of mixed between no cut, red line, and maybe one cut, the little dashed line. Then when we look at the third meeting from today's perspective, which is October 29th, which is this darker blue line here, this line is slightly below one cut. So right now, probability weighted, the market expects for end of October the first cut. Clearly, it's not even marginal. Like in the September meeting, right now the market is mixed, somewhere between no cut and one cut, but end of October is clearly one cut. After October, the next meeting is in December. This is light blue line here. And at the moment, probability weighted, this is mostly at 2 cuts from today's perspective. So this is not one cut in October and then another 2 cuts. No, this is the cumulative number of cuts from today's perspective, from today's level of 425 to 450 basis points. And you can see for December, right now the market prices in more like 2 cuts compared to the current level. And then the subsequent meeting, end of January 2026, the market clearly expects 2 cuts versus the current level. It's this purple line down here. This line down here shows you the performance of the equity market as represented by the S&P 500 index. You can see after the April trough, market has been ripping, recovered all the losses and added some. And what's interesting is that despite the gap between the red line and all these lines has been narrowing significantly. In other words, the interest rate cut expectation has significantly reduced. The market moved up. And the reason why it's interesting is, so it works the following way. Finance 101 dictates that fewer rate cuts means higher interest rates. Higher interest rates mean higher discount rates. Higher discount rates means lower net present value of cash flows. And in theory, this translates into lower share prices. However, as we can clearly see in this case, this is not what happened. The second observation we can make is that when you look at these lines, there has been enormous volatility. For example, when the upcoming meeting in 8 days, end of July this month, first was recorded in the market, that was last year in June. And that initial expectation at that point, 1 year into the future, was almost on the money. Market priced in slightly less than what is most likely going to happen in 8 days, i.e. the Fed is not going to change interest rates. But see what happened subsequently. And we have to quickly go through what happened here. So you had a dramatic drop from just under 425 bips to all the way down here, just under 300 bips. So this is an enormous drop. And this would be 1, 2, 3, 4, 5, 6 cuts. So what happened? So beginning of August, there was what I would call a flash crash. There was some worry about the Japanese carry trade. From memory, I think it was August 5th. There was a crazy sell-off. I told my subscribers, please buy stock. This is completely absurd sell-off. So what happened is the Japanese Fed, surprisingly to the market, to a surprise to the market, raised interest rates. And I'm not going to go through the mechanics of a carry trade, but ultimately these are very high volume trades which exploit a interest rate differential. Has been around for a long time. Every trader knows that. And it only works if there's enough of a delta between Japanese and US rates, and as soon as this starts shrinking, or at least the outlook of it shrinking is being priced in, a lot of people need to unwind that trade, and that caused a lot of forced selling. It kicked off in Japan, stock market was massively down, and then it triggered a US market sell-off, and this is what happened here. Then subsequently a bunch of other things happened, and this is why the interest rate cut expectation increased dramatically. Remember, when the curve goes down, the interest rate cut expectation goes up. It means more cuts, but since the election, all of this was priced out of the market. Then in the April 2025 trough, there was some repeat of increased rate cut expectations, but this was subsequently yet again priced out of the market. And this left the July expectation currently basically where it started off a year ago. And then when you look at the September expectation, when it first was available from trading data, you can see it was way too low compared to where it's probably going to come in later this year in September. That's the green line here. You can see it started off at below 355 pips. So that's basically 1, 2, 3 cuts from where the expectation sits right now. Before we wrap this video up, I just want to give you another point. This chart shows you the historical rate cut expectation of the prior 5 Fed meetings. You can see very close before the meeting, the probability weighted expectation converged to the actual outcome. So briefly before the meeting, the market was consistently always on the money in terms of what the Fed would actually announce. This shouldn't be surprising because the market also has the data the Fed is looking at. Plus, there are a bunch of Fed members that prior to the Fed meeting, they give speeches, etc. And from all this data, market observers, researchers can, with a very high accuracy, derive the most likely outcome. And that's why they consistently nailed it. But the point of this chart is that when you go further away from the announcement date, so if we go further left on this chart, you can see the huge volatility these Fed meetings experienced. So for example, if we just look at the darker blue line here, for which we have the longest trend. So for the meeting in December 2024, the final outcome was no cut, as we obviously know now. But at some point prior, so in April 2024, May 2024, the market had expected the rates would be 2, almost 3 steps higher. And then as late as September 2024, the market came down to actually 1 step lower than the actual outcome. So the point I'm trying to make is that the range was 4 steps wide, 4 25 basis point steps. So that's quite a lot. So in summary, the market gets very accurate just prior to the meeting, but in the months before the meeting, there can be significant volatility where the market can be significantly off the mark. And the last kind of statistical observation we can make from this historical trend here is that the initial estimate of the market, so when the curve starts, tends to be more on the money, closer to the final outcome, than the biggest subsequent outliers. So for example, if you look at the purple line, for example, this was the June 25 meeting. When it first was priced in by the market, it was basically right on the money. Then a few months later, deviated significantly from the final outcome before it converged back to where it actually came out. So before I wrap up, so bottom line is end of this month, there is a market that is not pricing in any cuts. For the next meeting in September, market is kind of mixed, and then for October, right now, 1 cut is firmly priced in. The big picture is that the market went up without huge rate cut expectations, which is actually a bullish signal, because should the market then start, for whatever reason, to price in more rate cuts, that would add additional fuel to a continuation of the rally in the stock market. However, before I let you go, I need to point out that currently the S&P 500 is priced relatively highly on a forward PE multiple. So you need to keep this in mind. Thanks for watching. See you in the next one. Bye.